I should be no more than about an hour today. I'll try not to go off on too many tangents and rants, but this topic kind of gets me going. And I started talking about this in the TheoTrade chat room the other day. I actually literally was going to use this topic, the hedge holder fold, and I actually stopped and I hesitated and I said, you know what, we just need to broadcast this to everybody. This isn't just for TheoTrade, peoples or everybody that's out there that gets emails from us from time to time. Everybody on YouTube, we're broadcasting it to them because I think it's such an important topic as you're seeing markets obviously at a very pivotal time frame, and we're going to discuss that here. So before I officially get started, we are not financial advisors or a broker dealer. I always mention that because I spent the previous 15 years of my career, of course, in the brokerage business. I started trading in the late 90s out of Chicago. I joined a startup firm called thinkorswim a little bit thereafter. And, yada, yada, yada. Here we are some 19 years later, but throw it up there. By the way, everything today will be recorded. The PowerPoint, I'm not going to really use a PowerPoint. We don't need no stinking PowerPoint for today. Copyright disclaimer. Although I'm not using a PowerPoint, you can't reproduce this, but you can probably replay it on YouTube thereafter. This is me, co-founder here of TheoTrade. As I said, I've had a 19-year trading career. I do have about 17 years of thinkorswim platform experience. A lot of the features that I'll use today, we help create many of the features on there. A little bit about TheoTrade. So if you guys are brand new, and again, you've had no webcast that you've attended from TheoTrade or not really familiar with us, we specialize in education for stocks, options, futures. We're founded, of course, by professional traders and trading educators with a minimum of 15 years of experience. We've actually got a couple of people like Slim Miller. He's got 43 years experience out there. And we're predominantly here, and this is a big portion of today's session. We're here just to help you mitigate the risks in the market. And that kind of skill set, it'll last you forever. TheoTrade, again, it's not just Don Kaufman. We have Doc Severson that works with us. Obviously stocks, options, and technicals. Specifically, he's into fractal energy, and so forth. If you guys are into technicals, you might know about that. Doc also specializes in RSI Laguerre. There's Jeff Bierman. Jeff actually worked with me for 7 years at thinkorswim and, of course, TD Ameritrade. In fact, Jeff, before leaving his tenure at TD Ameritrade, was the chief market technician for TD Ameritrade. It's a fairly prestigious position to hold at TD Ameritrade. They have 7 million clients there. Steve, better known as Slim Miller, 43-year. If you don't know Slim, he started actually trading in the mid-1970s on the floor of the Chicago Board Options Exchange. Slim has been around forever in the trading arena. Then, of course, we have Tony Rago. Last but definitely not least, he's our NASDAQ futures and intraday trading strategist. So that's a little bit about some of the group. Now, without further ado, we're going to cut right to it here. One of the things that people continually ask us, we do have classes that we offer from time to time. Our next class is going to be coming up this Saturday. It's consistent intraday strategies and setups. I'll talk about it a little bit towards the end of this webcast here, but we've already had a couple of questions in the chat room. But again, really, I want to spend the bulk of today's session really discussing not just markets, but again, the overall discussion here being hedge, hold, or fold, and really getting into detail about hedging and your broader market risk. So bringing up a couple of notes for myself as we get going here. So, all right, start with this. How many of you that are joining us today, and again, it doesn't matter where you're coming from, all walks of life, how many of you have some type of a stock portfolio? Now, that would include a 401k, could include an IRA, all right? If you're in Canada, all right, it's Canadian retirement savings account, but it just doesn't matter where you are in the world. How many of you, though, have some type of a retirement account? And it's okay if you don't. Come on, admitting it's the first step out there. So you're right. I didn't even mention the HSA account as well. So the vast number of people joining us absolutely do. And if you don't, it's all right, because the techniques that I'm going to talk about, I think, are essential moving forward. So we have a retirement account, and what we ultimately do with it. Now, that retirement account, it's just something that even if you're like a more active trader, and I fall into this category. So I'm active on a day-to-day basis. Like, I don't mind telling people I do sit in front of the screens for 6-7 hours out of the day, but that's what I've done for almost 20 years now. That's not necessarily right for everybody. I mean, yeah, I'm doing a class about intraday trading this Saturday, but that's not what this presentation's about. This presentation, it's not just about a retirement account either. It's about understanding, the overall risk that you're taking, and not, again, on a day-to-day basis, but with that retirement account. And I think that the place to start this discussion, instead of using the SPX, I'm going to represent the market by talking about the spiders. And I'm just going to open up a 3-year chart on the spiders. You know what? Let's have more fun. Let's just open up a 5-year chart on the spiders. Okay. So here is a 5-year on the spiders. All right, great. See anything maybe a little bit intimidating? All right, everybody has to agree. There's been a lot of upside in the last 5 years. And the question right now, so, we really believe we've kind of come to a crossroads in the marketplace. But the question is, right here, right now, is what is your risk versus the upside reward? Now, I'm going to put no directional bias into this, and I'll let people know I am bearish. I've been bearish for a period of time, but I don't want to influence my directional bias to the idea of you hedging your retirement portfolio. And again, even if you don't have a retirement portfolio, the techniques we're going to talk about today are still imperative over the duration. Because, whether you're building up an account that has $2,000 in it or you have $2 million in the account, you got to be a little bit nervous on both sides of that. So as I kind of reiterate here, looking over the last 5 years, well, what do you think of the chart? Of course, everybody's like, well, this thing is kind of crazy over here. So you have a 401k, it probably has some mutual funds in it. Okay, you have an IRA with, a ton of different stocks. What is your strategy for risk mitigation against those accounts? And it's a fair question. It's just one that doesn't come up very often, but it's not only a fair question, I think it's relevant right here, right now. So we started this discussion again in the TheoTrade chat room the other day. The fact of the matter is, in just the last few weeks in markets, we're obviously seeing a lot of tone of the market change. So we're getting an inordinate number of emails here at TheoTrade discussing like, hey, can you talk about hedging the portfolio? I'm kind of feeling markets may turn over there, hence this topic being hosted today. So if you have the belief at this point that markets could actually come down to a degree, listen, we don't know what that means yet, right? When I say the markets could come down to a degree, you look over the last year, right? And the S&P's just shot, just the last few months, these things just shot from 210 to 235 on percentage basis. And again, I like to put things on percentage terms. These are unprecedented moves, right? Here's where the S&Ps were relatively flat. Again, I'll draw on the screen a little bit from time to time, but here's the S&P that was, basically on percentage basis 0. And here it is basically up 14%. So from this most recent low here before the election to right this moment, we're pretty much up 14%. And that's stemming from early November. Again, that's the kind of, that's the kind of thing that we want to look at in terms of percentage returns. Clearly, there's been incredible upside. So what's changed in the last couple of days? Well, where do you want to start? Literally, where do you want to start with the last couple of days? First and foremost, there's a lot of indications from volatility that we have some serious risks ahead. I know that many people are centric to the volatility index, but unfortunately, the VIX is about as dead can be. The VIX won't see risk, okay, until the house is on fire. It's basically like, oh, there's smoke. Somebody call somebody. The VIX is a dead product. The volatility futures are indicating, okay, that there's structured risk incoming right now to the marketplace. In fact, we actually have an inverted volatility skew as of the close. The irony of this is the volatility skew itself being inverted, okay, it's indicative of what? In the next 13 days, apparently we're expecting more volatility in the next 41 days. I read an article last night that said it's the French election. Yep, that doesn't really work because the French election is after 13 days from now. So it's kind of an issue that nobody can explain. So the volatility futures are starting to display risk. The bonds are starting to display risk. Instead of selling off like everybody believed, the bonds have actually been rallying over there. So there's this myriad of risks. But the one thing that, again, even yesterday, you heard from the FOMC that they're getting ready to get out of their portfolio. The FOMC is not only raising interest rates, so you get this myriad of risks. Forget all that. Forget all of it, okay? It's all secondary stuff. What we have to recognize is a very, very simple idea, okay? And the very simple idea is there's a glut of capital that's been pushed out there at extremely low interest rates, okay? We now know that the Fed is going to start mopping up the excess liquidity over there. A huge amount of this liquidity being pushed into the markets is contracting everything from bid-offer spreads for those of you that trade more actively, okay? You look at the spiders. The markets are a penny wide. Like, how do they even do that? 24, 25. I mean, markets are literally a penny wide. The bid-offer spreads have never been tighter than they currently are, okay? And it's because you have this immense amount of capital concentrated into these products, fighting for fractions of a penny. And that amount of capital just creates this incredible efficiency throughout the markets. It's also boosting the markets higher. Now, okay, the exact same efficiency that causes markets to have incredibly tight bid-offer spreads and has caused markets to have moving in such orderly fashion. And that's the only way to describe markets right now, how incredibly orderly they've been, you know, year in and year out. The last serious volatility we saw was August 24th of 2015, where the market sold off for 7%. We believe we got a glimpse that day, a glimpse of what volatility could look like. And that's, of course, right back here, a fairly wild decline and bounce all inside of one day. But you have to recognize and just substantiate how much risk is really packed into this market. And again, this is outside whether you want to be bullish or bearish. So with that, I think it's just imperative moving forward that we talk about risk mitigation tactics. And to do that, let's first of all, let's start to discuss like a 401k, okay? And many people that are listening today have a 401k, and I don't want to alienate anybody. If you don't have a 401k, it's fine. But if you do, we're going to start to group things together. So, you know, you might have a 401k. Okay, so here's your 401k. I don't know what you have in it. Let's say it's $150,000 inside of a 401k. Some people be retired, already drawing on the IRA, but if you have an IRA, and by the way, I'm really familiar with all the different types of retirement accounts. I did spend 15 years in the brokerage side of the business, but I ran the education division of TD Ameritrade. But I know all the different account types over there. So you may have, $60,000 tied up in the IRA and on and on. And then you have a regular like marginable account. You know, most people have more than one account. They have their trading account, their IRA, then a 401k that exists at a separate firm over there. So over here, for instance, is your margin account. And that margin account, maybe has, I don't know, let's just throw a number. It's got $25,000 in it to, the day trading margin rule. The first thing you want to do is quantify, all right? What's in the accounts. You got to know what's in your accounts. And what's in the account? What's in your 401k? Well, Don, I have a couple of mutual funds out there. What's in your IRA? I got a, bunch of stocks, yada, yada, yada. Okay. So the next thing, you look at these things and you're going to see an amazing correlation between what would be in your 401k and your IRA. You might not think so, but the markets use a standard, and the standard is something that we're going to call beta. Now, for those of you that have never heard of beta before, and again, I like to do this just on the screen. We don't need any PowerPoints. Just going to run with it because your portfolio is flexible, as are our examples, and we'll be able to answer some questions, in a more live fashion this way. So there's this standard called beta in the markets, and what beta refers to, okay, beta is the relative movement versus the S&P 500. So if beta in the S&P 500, okay, is always set to 1, and you have a stock that has a beta, for instance, of 2. So for those of you that have never really heard of beta, or maybe you've heard of beta and you never really looked at it, but if the S&P 500 is always a standard, it's a beta of 1, okay, then you have a stock of a beta of 2. What that really means, it means for every 1% move of the S&P, and I'm pointing here to the spiders, for every 1% move in the S&P, you're roughly getting about a 2% move inside of your particular stock, right? So a 2 beta is really high because that's like it's moving at 2% versus every 1% move in the S&P, 500. So when you start to dig into the 401k and the IRA and a marginable account, what you're going to find out, look at the actual securities. You're like, I got me some Apple. Yeah, like no kidding. So does everybody else. I got me some Facebook. All right. Yeah. Okay. So does everybody else. I got some Exxon Mobil. Oh, I've never heard of that one before. Sure. I own this, and then somebody always comes up with, I own the emerging markets ETF. People love ETFs right now. So you own the EEM, emerging markets ETF. You own some Spider. You own some Google, and it goes on and on. Right? Blank the slate over here. There's a reason I just talked about beta. Go look at it. Now, it depends on what trading application. That's neither here nor there. Am I using thinkorswim? Yeah, okay. I spent 17 years working there, so I know the platform fairly well. 15 years working there, 17 years in the application. Look at the beta of the spiders. So this is where things get interesting. You look at the beta of the spiders. The spiders are supposed to move with the S&P 500. The beta is basically 0.99. Close enough for me, right? And that's a fast beta, but we'll come back to that momentarily. Then, you go look at EEM, okay? Let me fix the beta on here because I do apologize. I've got my beta set a little bit different. By the way, yes, you can set beta differently on the trading application. If you've never seen this before, there's a fast beta, there's a slow beta. I'll go back and change it to the standardized beta. Okay. What I want you to see on the EEM, and you're going to find some huge irony in this, is if you looked at the emerging markets, because some people, they're like, oh, I have a money manager, or my mutual fund manager that does that. And they turn around and they say, well, yeah, they've got me into some emerging market stuff. They got me weighted towards Brazil. Yeah, the emerging markets have a beta of 1. So what's the difference between it and the S&P 500? Apparently not very much. Just keep that in mind, right? And then, I talk about some other ETFs over there, or like something like Exxon Mobil. Exxon Mobil has a 0.88 beta, right? Then you go look at something like Google. Google has a 0.97 beta. So what's the difference between Google and the S&P? Apparently not that much, okay? Then we go on to other stocks like Apple, right? Oh, it's a 1.1 beta. So if you added up the beta from Exxon Mobil and Apple, you know what you got? You got yourself the spiders. Oh, let's get crazy over here. Let's go over to something like GE. Ooh, it's 1.18 beta. Why am I showing you the betas? Like literally, why am I showing you the beta? That's a good question, right? And it's a fair question. Here's GE. Totally dead for like the last 3 years, right? But why am I showing you the betas? Anybody? Anybody? Come on. Questions are open for interpretation. Okay. Nobody's got an answer to that one. What do you think the beta? When does the beta really, really matter? When do betas matter? Okay. See, when markets rally, they have tendency, individual stocks have tendency to move in autonomy. And that basically means when a market rallies, like the S&P 500 rallies, Google might rally more. Tesla will rally more, okay, than the S&P 500. People always ask me about like Tesla, what's its beta? You'd think it'd be extreme, but it's 1.26. Okay, so Tesla's exploding to the upside, but its beta is really not that much more. By the way, Tesla, it's up like 40% year to date. The reason I bring up the beta is because, number one, you find out in the end, if you mush all your stocks together, when I say mush them together, you got Tesla and ExxonMobil. Okay, I'm whacking the microphone over here. You got Tesla and you got ExxonMobil. You got some Google. You got yourself some Apple over there. You know, I can move from the tech stocks. Oh, we have GE. And do you realize that just adding them all together just equals a beta of 1? So basically what you're doing is recreating, in most, for intents and purpose, you're recreating the spiders in a lot of cases. You're like, I've gone out of my way to recreate the spiders. The other reality is, okay, just bear with me here. I know that this is, I don't want to get negative here, but if the market did something crazy, like sold off one day, you're going to know what beta is. Why? Because betas, they don't matter that much when markets are rallying, but when markets sell off, oh boy, beta means everything, because you're going to start seeing, okay, the portfolio move with what they term systematic risk. There's two types of risk to a portfolio: systematic and systemic. Systemic is like when the whole entire system falls apart. That's like in 2008. But you'll find out pretty quickly what systematic risk is. What systematic risk is, and for those of you, again, that have no clue whatsoever what I'm talking about, I'll show you the S&P 100. This is the S&P 100, okay? Today was a trading day where the market was kind of choppy and all over the place, okay? So today, there's not a high degree of correlation. Correlation is right here. So this is the S&P 100. And as fast as I can drag my mouse, you can see what stocks are up and what stocks are down. But the reality is, when markets, they're choppy like today, things kind of move in their own, realm. When the markets sell off over here, everything goes down. You'll see 99 stocks or, 95 stocks declining. Correlation kicks in and everything matters at that point. The beta matters as well. Okay, so you take this substantiation of risk. Diversification in today's marketplace is utterly ridiculous. The idea of diversification is ridiculous. Why is it a ridiculous notion to be diversified? What are you going to diversify into? Every asset class over here is connected now. All right, everything is connected like dominoes. Right, that's how the arbitrage systems, and that's how computers ultimately run portfolios today. Everything on this entire screen is interconnected. So we come to this crossroads where you have to decide, like, if you want to hedge your position, or do you just want to hold it, or you just want to fold completely and get out of a portion of it. Okay, and the reason I'm setting you up to understand how much relevant risk there is right now, because people have no clue. They're going to get pummeled. This is not a matter of like, if the market sells off. You're just marking time right now. And what's going to be unfortunate is this decline looks like it's going to be huge. I mean, this market may not give you time to think. You need to understand right here, right now. Look at the spiders. Forget about the entire portfolio. It doesn't matter. Because the portfolio itself, whatever it is going to move in some relative tandem notion in notional value with the S&P 500. That's why I explained beta a little bit. You look at the portfolio and the spiders are at 235, pretty much on the button. If we start to sell off and you have a portfolio, okay, when are you planning to pull the ripcord? Okay. By the way, people mention like products that are less correlated over there. Sure, you can go to gold. You want to go to gold? Gold, historically speaking, carries more risk than even the equity markets. Think about it. Okay, currency issues, right? I'm frankly a little scared of gold, and I'll tell you exactly why. Because somebody mentioned gold, but I have no problem. I'm a little scared of gold. Number one, because it just rallied, like a ridiculous amount. But that's not it. I'm actually scared of gold because the French election. Depending upon which way that one falls, you put a huge amount of risk into gold because the currencies are going to rock one way or the other. The euro rallies, it could actually crush the US dollar. Is gold going to go up or down? Then, okay, on the other side of the French election over there, what if, France all of a sudden, that's it, we're pulling out of the euro crashes? You couldn't even tell me which way gold's going to go. because the euro can start crashing, burning out there. The US dollar gets strong, and they're actually going to crush gold because the US dollar is getting strong. It's a convoluted mess that we're in, and you have to recognize it. But I'm not going to go down that tangent today. All right, that one, save better for another day. Okay. So here's the S&Ps at 235, and I say you have to figure out when you're going to pull the ripcord, but more importantly, aggregate your risk, know what your risk is. We're actually going to talk about for the next 30, 40 minutes, moving your risk forward. What does that mean? Okay. What's your risk moving forward? So I want you to take your entire portfolio, whatever your portfolio is. I need to know the value of your portfolio. You don't have to tell me. You need to know it. I apologize for that statement, meaning like you got to know to pretty much the dollar how much your portfolio is worth. And I want you to put your portfolio in terms of the spiders. Okay. And this sounds like a kind of a strange exercise, but I'm going to show you exactly how to do it. And this is exactly what you teach portfolio managers to do. So I'll give you guys a little background. I worked at this startup called thinkorswim. I originally went to Chicago. I started trading in the late 90s, a couple of weeks out of college. I was invited to the startup called thinkorswim, and we used to build, obviously, retail technology, but I was pretty much on the trading side of the business, and I helped, some of the features in thinkorswim, but I also worked with a lot of institutional clients. And when TD Ameritrade bought thinkorswim, for 18 months, I worked exclusively with clients that had $300 million or more, okay, under management. I worked with institutional, okay, and registered investment advisors with $300 million or more under management. And one of the skills that we used to teach them is the exact premise behind what I'm doing right now. And that's this, okay? Take the portfolio and aggregate it. Take your portfolio and aggregate it, all right? I'm going to show you what aggregation simply means. This is a mock portfolio. I just mocked it up right here in the analytics tab of thinkorswim. What is in the portfolio? Okay, so timeout. It's just a portfolio. There are no options in here. Okay, nothing up the sleeve. There's no options. There's no short positions. I just bought some crap. Everything's crap. It doesn't matter. Oh, it's Amazon. I love Amazon. Who cares? All right. Jeff Bezos couldn't be another, a nicer guy over there. Send him in his rocket. I don't know if you guys saw this. He's taking like $1 billion a year to fund his rocket. Some strange individuals there. Anyway, in this portfolio, we have Apple, Amazon, Bank of America, Caterpillar, Facebook, Intel. We actually have some spiders apparently up. There's actually no spider shares in here, but that's fine. And ExxonMobil. That's my portfolio, okay? ExxonMobil and Intel, but everybody has a bunch of this junk. Then what you need to do, look at the physical portfolio and figure out what it's worth. Do not look at margin, okay? You need to know the cash value. Let me explain. Here is Apple. Apple, apparently in this mock portfolio, I own 300 shares, okay? So what you need to do is you need to take the 300 shares and multiply it by the current value, which is around 143. Let's just call it 143. So take 300, multiply it by its $143 stock. That equals about 42,000 and change, almost $43,000. Okay, so let me take you through a little bit of this exercise. So this Apple is equivalent, okay, to about $43,000. Then we have what? 40 shares of Amazon at 900. What's that equivalent to? So I'm doing some quick math over here. 40 shares times 900 equals this one. It's about 36,000 bucks. Then what do we have? 600 shares of bank multiplied by what's a $23 stock? I'm just rounding. Just get it done. Quick and dirty. Quick and dirty. It's about 14,000. Then we have 200 shares of Cat at about 95. Okay, that's about 19 grand over here, and on and on and on and on, right? And again, if you want to do Facebook, there's 14,000, and then I own some shares of Intel that are off the bottom of the screen. Okay, add up. This is the value. Okay, we need the aggregated value. Don't tell me, individually. Take the aggregated value of the entire portfolio. In this particular case, I'm going to unfreeze the screen for a second. In this particular case, I've also got some shares again of Intel, some ExxonMobil. I added up the value of this portfolio prior to. The portfolio that I have created here, okay, has, and I'm just rounding it, $157,000 of value. Okay, so this portfolio, whatever it is, has $157,000 of value. So that's the first step. Exclude all cash. Exclude all cash. Don't worry about bonds. Don't worry about gold. Okay, I want pretty much right now notional value of ETFs and equity products. Put in ETFs. It's like EEM, Spider. Put it in there. Don't worry about margin. Exclude all margin. This portfolio is worth $157,000. Okay, time out. Now that you know what's termed the notional value of the portfolio, what that basically means, notional value. Okay, why am I using the term notional value? Because I want you to imagine that Apple and Amazon and Bank of America and Caterpillar and Facebook, Intel and Spiders, this really is equivalent, okay, to the Spider. And it's equivalent to how much? $157,000 worth of Spiders. What is that in terms of Spiders? You're like, what? Well, the Spiders, what are they trading at? Go back to the trade tab. Look, there's the Spiders. What are the Spiders trading for? 235. Okay, so now we're getting into higher math over here, right? What you need to do is you need to take your portfolio. What is it? It's $157,000 portfolio, okay? And you need to turn that into shares of SPY. How many shares of the Spider is it? So, well, how do you do it? Take $157,000. Okay, in fact, here, I'll even do it with you all on the screen. Okay, this is the higher math part, and believe me, this is about as difficult as it get, right? But you take your $157,000, okay, and divide that by the share price, which is 235, equals, you have about, let's call it 670 shares of the Spiders. So whatever your portfolio is the equivalency of about 670 shares of SPY. This is actually what we term, again, notional value methodology. And it's one of the key factors in learning how to hedge or mitigate risk of your portfolio. If you can't do this, all right, you're going to have serious issues. By the way, how do you deal with mutual funds? Mutual funds are really easy because a mutual fund, you can actually look at the value of the mutual fund. If the mutual fund, you know, it'll actually say like you have $157,000 of the 2050 fund. That's it. That's all you got to do. Your mutual fund, I'll put any amount of money on it. Your mutual fund is actually going to have a prospectus. First of all, they have to mail you the prospectus multiple times a year because it's the law. That's, you know, FINRA and SEC regs, they got to actually mail the prospectus. If you go and look at your mutual fund inside of the prospectus, that's the booklet that you chuck in the mail. You know, when I say chuck in the mail, you chuck it directly from the mail to the garbage, right? If you're like around this house, I don't even get to see the mail. The bills that I need, they come digitally. Everything else that goes in the mail goes in the garbage, except, of course, the Costco coupons. Anyway, if you have a mutual fund, you look at the prospectus, it'll actually compare it to a beta. It'll actually tell you the beta of the mutual fund because it has to be in there. But then, by the way, my favorite thing to rip on the mutual fund managers about is they always compare the mutual fund to some estranged, that's not strange, estranged index that you've never heard of. Think about this for a second. If you've ever looked at a prospectus, they'll be like, yeah, so we kicked the crap out of the Lipper. Yeah, the old Lipper 5000. I know of the Dow. I definitely know of the S&P. I don't even like the Dow. I know the S&P. I definitely know the Russell. Excuse me, what the hell is the Lipper index? Okay, is that leper, like leper colony? No, it's the Lipper. Why do they do that? Because the Lipper sucks worse than anything on the face of the earth. Okay, and literally a monkey outperformed the Lipper. If you don't remember that, the chimp's name was Raven. The chimp finally passed on, but this happened actually all the way back during the internet boom. People remember this, the Wall Street Journal, that a contest with the monkey that was outperforming most of the major indices and the mutual fund managers, but I'm pretty sure that's where the lipper came from. Anyway, with that, the mutual fund's easy, typically compares right to the spiders. Take the value of the mutual fund. So if the mutual fund value is $157,000, just divide it by the share price, okay, of the spiders, and boom, you got it. So now you know that you have equivalency of about 670 shares of the spiders. We good? Are we good? Okay. Once you've actually got that, okay, time out. This is how you gauge your risk to begin with. We're just going to gauge risk. We're not talking about hedging yet. We're just going to gauge risk. Okay. Go to the spiders. Use the spiders. Don't get cute. Try to find an option that's about 30 days out. You don't have to go 50 days. It doesn't matter. Just start with 30 days. I think it's a good starting place, because what is your risk for the next 30 days? Now, go to the spiders and look at what's termed over here on the right-hand side of the screen. This is your expected move. If you don't have thinkorswim, that's fine. Stocks trading basically at 235. Take the at-the-money options, and if you've never traded options, just add them up. Look, add this put to this call. For the most part, just round at $6. Okay, so the expected move over here is, in this particular case, right there. It's $6, okay, and 36 cents. So if that's my expected move, that's normal. That's what the market's anticipating a normal fluctuation is going to be. Like, this is going to happen. We're going to move up or down $6 roughly in the next 29 days. Got it? Pretty easy, right? That's a normal distribution curve. There's absolutely no directional bias in this little curve because it's a distribution. It's just showing you price is going to fluctuate in a $6.36 range. Now, we have to figure out what your risk is going to be. Take the expected move and double it. Now, don't get too cute. Just take it and double it, right? So you have $6.36 times 2, okay? Let's just call it $13. So an abnormal move is going to be like $13, and that's what we're going to call, okay, the expected move, but this is times 2. So the expected move times 2 is basically $13. So you're looking at having as much as a $13 range. An extreme move, sure, we could move 3 times this, but it's a great way to gauge your risk. Now, go take, all right? I know this gets, like, this is math, man. Don't worry, this stuff's recorded, right? Take the $13 and multiply it by the 670 shares that you're long or short. Doesn't matter, does it? Okay. You're looking at taking $8,710 of risk, okay? That's your approximate risk in the next 29 days. Now, time out. Go fish. You like it? We started with a portfolio. It was $157,000. And a $157,000 portfolio, you're taking close to $9,000 of risk. You can figure out on the percentages, okay? By the way, if you have a covered call, don't worry. Just admit the call. You don't even need the call in there. Just figure it out, because the covered call doesn't protect you to the downside. So you still have $8,710 of risk, right? So, and your delta is not going to be reduced by the covered call in the midst of a sell-off. It's not. The call is only going to collect $1. So it's actually, there's no definitive hedge to that idea. So now think about it. Are you comfortable with $8,710 of risk? It's a pretty good starting place. I think this is a fair question. If you cannot answer yes, whatever your portfolio is, you got a problem. Now you need to know, okay? The whole topic here is hedge, hold, or fold. So you're going to hold this? That's the next 29 days. You want to get serious? Why don't you go look out in the future, because the market doesn't even see risk right now. Go 50 days out, and there's an $8 expected move. Times 2. I don't know. Let's just call it almost even $20. So now you're actually taking $20 and multiplying it by 670 shares, and you realize you have $13,000 of risk, very likely in the next 50 days on a $157,000 portfolio. It's not looking that good. It's a lot of money. It's a lot of money for 157 grand. But at this point, you have a pretty good idea. What are you going to do? Okay, so let's go take the equivalency. In this case, we had about 670 shares. Okay, and I'm going to take this and I'm going to go analyze it. So we're going to analyze the trade. I'm going to get rid of the portfolio. I just want to look at 670 shares because this portfolio that we created a moment ago, this portfolio of Intel and Facebook and yada, 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 okay, that entire portfolio equaled the equivalency of about 670 shares of, Spider. So now that you know that you have 670 shares of the Spiders, what can you do to possibly mitigate that risk? Because you decided maybe you don't like the $8,000 of risk, okay? Rule number one, because everybody comes up with like some crazy idea like, oh, I know how to hedge my risk. You can come over to to options and you could probably buy puts. Could you buy puts to mitigate risk? So let's go out about 30 days, and I'm just using 30 days, and here's a 35 delta option, okay? Could you imagine if you bought, here's a put, okay? It's a 35 delta put, which what? Gives you the right to sell the stock at 232.50. Here, we'll use this. It's even easier. 233 put. It's trading for like $1.90. Could you imagine if you bought a put for $1.90? Okay, you just bought it for $1.90, but then you had to do it 12 months out of the year. Okay, that'll equal $22, almost $23 including commissions. Now here's something fun. If you take, okay, that amount, take the $23. You just do it by yourself because there's fun with numbers over here. You take the $23 and you divide that by, the 235. Okay. So watch. Take the $23, divide it by $235, which is the price of the Spiders. It'll cost you, again, about 10% including commissions. Meaning that if you bought this put once a month for 12 months, that crap's going to cost you 10%. What's the irony in there? 10% on a product, the Spiders, that's only been shown to appreciate by 8% in any given year. So you think you're going to be able to buy puts? Well, you could. You could buy puts, but the problem is the puts don't even kick in till 233, which still leaves you pretty good downside. So the first step to hedging that everybody seems to miss, okay, when you go out and buy a put. So go back over here to the Analyze tab, and I'm just going to round this out. Let's say that this was 1,000 shares of the Spiders. 1,000 shares of the Spiders. What is 1,000 shares of the Spiders worth? Well, it's a $235 product, so it's $235,000. But you got 1,000 shares of the Spiders. Okay, and I just rounded it to make the numbers easy. And that 1,000 shares of the Spiders, somebody says, you should go out and you should buy you them one of their puts. But how many puts am I going to need? I'm going to need 10 puts. So I go over there and I analyze the trade. Do you know what buying puts does? Buying puts takes my delta, which is the number of shares I have, and chops it to 630. Look, no puts, puts. No puts, puts. All the puts do is chop the delta down. All puts do is chop the delta down. Okay? It's delta hedging by buying puts. Well, guess what? If you're long 1,000 shares and buying a put reduces your delta, why not just go sell like 300 of the shares? Like, what the heck is the point? Or even 400 of the shares? You could just sell part of your position. And that's one of the most effective hedges in this industry. People want to be cute. They want their cake and they want to eat it too. I could buy a put. I can have my cake and you can eat it too. Yes, but you're going to buy the put and you're going to pay $1.90 for it. And if the market stays flat, you're going to lose $1.90. And if the market goes up, you're still going to give up the $1.90. And if the market goes down, that $1.90 isn't worth anything. 233 is where the hedge kicks in. But it doesn't really work until almost $2 lower. So now your hedge is not really at 233. Your hedge doesn't even kick in until 231. I know I'm throwing a lot of numbers at you over here. People, you got to understand, this opens up the door. The idea of the hedge is archaic. It doesn't work. Somebody goes, I'm going to use me one of them dare stop orders. Yeah, well, one of them dare stop orders ain't going to work either. Because if the market does crash by 7%, at the cash open, you don't get out. August 24th of 2015 was evidence of that. Okay. In this discussion of hedge, hold, or fold, one of the primary themes needs to be, if you don't like the heat that you're about to take, lighten the position. It doesn't mean it's all or none. It doesn't mean it's all or none. Now, I'm going to take it even a step further, because somebody inevitably will say, you know what, Don? You could buy the puts. And then you could turn around, you could sell those calls. Let me fix that really quick. You could buy the puts, and then you could turn around and you could sell calls against it. And that's actually called a collar. More importantly, it's a cashless collar. This is the most ridiculous trade you could possibly do. If you take the trade and analyze it, all right, I'm going to do, in this case, just 6 contracts of it. Let's just do 10 contracts and bump the whole thing to 1,000. Okay. You can do what's called a cashless collar. And in this particular collar, let me make sure that we got the trade in there correctly. All right, come on. Come on, something's broken over here. The trade itself, the cashless collar, is nothing more, okay? Again, what we're doing in this case, we've inverted it, okay? Hang on just 1 second. It inverted my trade when I brought it over. There it is. In the cashless collar, okay, all it's doing is locking up what you can make to the upside and still taking more downside risk. It's pretty interesting. I'm looking at the risk graph of a cashless collar. It's a vertical spread. So there's so many misnomers in this business that this is actually a good trade. Let me tell you, from the brokerage standpoint, brokers love when you do collars, because now you're buying the stock, commission, and tying up your capital. Then you're actually buying a put, commissions, and selling a call to finance the cost of the put, commission. And you're putting yourself in a deficit position over time. This is not a good trade. The collar, the only, there's stories of collars being these wonderful trades. They were, okay? Larry Ellison made billions off of collars. Mark Cuban made billions off of collars. That's before they actually even passed Sarbanes-Oxley, meaning if you're actually an officer or a director of a company, you can't use a collar anymore. It's illegal to use a collar now. Back in the day, they could actually trade collars. That's how they made billions off of it. They would basically buy puts against their own stock, even if they knew it was going to be a crappy quarter. It's brutal. I mean, that's what happened back in 2000, 2001, 2003. And then they passed Sarbanes-Oxley, and you had to sign your name on the bottom, the bottom line over there. But this trade, in effect, does nothing except mitigates your risk and ties up money. It's just a money grubbing strategy. That's it. The easiest way for risk mitigation. And I know that, we had to go through this long explanation to say, cut the share size. Selling covered calls, I think, is a wonderful idea. But there's an issue with selling covered calls right now. If you understand implied volatility, you're selling yourself into the lowest implied volatility recorded in these markets. Pretty much selling into the lowest implied volatility recorded, all right, ever. I know back, but the VIX was lower here. Well, overall, it's the lowest implied volatility you've ever sold yourself into. So you're getting less premium. The less premium you get for those covered calls, the more, again, systemic risk that you actually are taking in the markets in the long run. And covered calls can be wonderful. If you sold covered calls, for umpteen, years out there, you've collected a lot of premium. But we need an idea right here, right now for hedge. Do you hedge it? Do you hold it? And if you want to hold your portfolio, that's fine. Okay. If you're willing to weather the storm of volatility, then sure. Okay. But at some point, got to ask yourself, what's the risk reward of the portfolio? And am I trying to scare you? No, I'm trying to challenge you. It's challenge you because think about how much risk is really out there. Margin balances have never been recorded higher than they are right now. Retail clients in this industry, in the US, retail clients have never recorded more bullish positions on more margin than ever before in the history of the markets. Professionals have never recorded more short positions ever before in the history of the markets. That's kind of scary unto itself. You got more retail margin being eaten up before than ever. You've actually got markets at all-time highs, and you've actually got the entire institutional world, okay, flipping more short than they've ever been. Like, what else does it take? You have the S&Ps at a pivotal level. You have volatility displaying risk, even though people are looking at the VIX and they're like, the VIX is as low as it's ever been. That's because the VIX, okay, is blind. The VIX is looking 30 days out. The risk is a tighter time frame. I'm not telling you duck and cover. I'm telling you, you better have, okay, an intimate knowledge of what your aggregated risk is at this point. And the easiest synopsis of how to mitigate that risk is to actually pull part of the position off. I'm not telling you dump everything and get short like the rest of the world over here, because frankly speaking, we don't know. Is this the top? Maybe not. Okay. Everything's going to work out fine. We're going to explode up to 250 on the spiders. Okay. We'll all go home happy. But at some point, you got to start to question the risk reward out there. And I'll even open up like, here's 20 years in the spiders. And at some point, that upside potential isn't worth the downside risk. It's called the juice. Is the juice worth the squeeze? Okay. And in this particular case, I can't honestly answer yes. Is that upside potential worth the downside risk? To me, it's not. Everybody's going to have to, decide that for themselves. But I wanted to get a lot of the myths out of the way with trying to poke around here and buy puts, because buying puts can be a very costly mistake. Sure, they can work. But if you're going out there buying puts, whether it's 7 days, you can buy puts 106 days out. It's going to be outrageous. But you could have your cake and eat it too. Yeah, but the market could also crash 15%. The put won't even kick in. And if the market does rally, you're giving up like $3 or $4. That doesn't sound like a lot, but on a percentage term over, multiplied out, it's more than the spider's return in an average year. These markets are really efficiently priced. And the same efficiency that's pricing these markets, okay, is going to turn into pure, utter volatility. So I'm going to answer a couple of questions. All right. By the way, the puts should be further out in time. Puts further out in time are going to be worse because the delta of these puts is not going to move. So people make this, it's a critical mistake. If you buy puts 106 days out, it's one of the questions in here. What's going to happen is if the market sold off today, this delta of 27 will go deep in the money, okay, to like where these 250s are. It's going to give you a very crappy hedge. You're not going to get a 1-for-1 hedge, which means it's only going to mitigate, maybe 70% of your risk. You're not getting a 1-for-1 hedge like you expected over there. So using puts further out in time is a crucial error in doing that. And again, people promote this, but even if you bought, watch, 106 days out, even if you bought like a $4 put, okay, so you bought puts, let's say 3 times a year. I'm just rounding. I know there's 365 days in a year, but let's say you bought 3 times a year. That's still going to cost you $12 plus commissions. You're going to be in it for $15. So then you've got $15 divided by a $235 product. It still equals 6%. That doesn't even hedge you for the full year. And that 6% that it's going to cost you to buy those puts, okay, which doesn't even cover you for the full year, isn't going to give you a 1-for-1 hedge. It's not as good as buying the shorter duration puts. The interesting thing is the efficiency of the marketplace is such that, you can't have your cake and eat it too anymore. It doesn't exist. That's how efficient things have become. But I'll reiterate my stance over here in that the same efficiency that brought us to where we are is what's going to rip us apart. The moment the world really thinks that liquidity is about to be mopped up, that the Fed is serious, they're going to unwind their portfolio, yada, yada. These things are going to come down faster than you're ever going to be able to react. I am telling you, if you want to hold your position, this is fine. Cut the position size, okay, to a comfortable level. Recognize that you may not be able to get out. And, okay, if you have to look at the spiders, forget about the individual stocks. Like people are like, on Apple, I'm going to get out here. And on this one, I'm going to get out here. You can't do that. You got to look at one common product. Pick a number on the spiders. If it crosses below the number, pull the ripcord. That means get the hell out or get out of a portion of it. If we get to 230, you unload a third of the position. If you get to 220, you unload another third of the position. You crack through 200, you duck and cover and just sit and wait for a while. You don't have to be out of the market forever. Okay. But what would you rather do? Would you rather ride it for 235 all the way back down to 200? We'll come back one day. Yeah, unless, of course, we go back down to 180 on the spiders. It's the reality. People do this constantly. Stay away from triple leverage ETFs. They're going to be the death of you. Triple leverage ETFs. So if you go to stuff like SDS, okay, these products decay over time. They're horrible. You're being charged a ridiculous amount for the leverage in here. This, okay, this is real. I know this is 10 years, but if you went out and you bought just a few years ago, okay, if you bought this product at 100, it's now worth 13. People look at products like the VXX. This, okay, there's more lawsuits about this product than any other product I can think of. The product has literally gone from 30,000 to 15. Buy one share for $30,000, you too could be worth $15 right now. Oh, the only one that's worse is the UVXY. You know, again, these are real numbers. The thing went from, yes, if you do the math over there, you're like, what? Down to basically 15. You don't even have to have, like, that chart's too big. Just look over the last 3 years. It's a $9,000 product over 3 years down to 15. It's just not, it's not even fair for, like, retail clients are buying products they don't even understand. Okay. You can't hold the UVXY for more than a day or you lose money. The SDS, all the triple leverage ETFs. You know, if you look at the marketplace and you want to get short the market, if you wanted to get short the market, you can go buy a product called like SH. It's a non-levered inverse ETF. The leverage will kill you in these products. Keep it in mind. With that, one more thing, because I know we've had a couple of questions right up front about it. We do have a class, of course, coming up. That class is going to be this Saturday, okay? Everybody that's, you know, in TheoTrade, you're already part of the class over there. It's consistent intraday strategies and setups, and I'm going to answer a couple of questions as they're rolling in over here. I am doing a class again. It's this Saturday, okay? There are 7 bonuses with the class. All right, a couple of these are really important prerequisites for the class. This is even people, if you're listening in the TheoTrade chat room, okay, watch the prerequisites for the class, please. Bonus number 6, what products to watch and why class is essential prior to coming to this. This particular class is going to be, this is not so much about hedging, holding, or folding. This class is about intraday trading. It's about using options, okay, to mitigate risk and substantiate decent returns on an intraday basis. Okay, we also have a specific indicator for the class and for trading where it's part of it. Okay, it's TheoTrade, you know, chart setup. It's my chart setup, and if you're curious what it looks like, okay, the indicator, of course, that we'll be sharing during the class, before the class, it looks like this. Okay. Let's come over here to the S&Ps where it makes a little bit more sense. Okay, go over here. This is actually the indicator that we're actually going to explain a little bit in the class. It's a much more quantitative indicator. I do not use technical setups. People talk about like it's red and green flashing arrows over there. I don't use technical setups. I use quantitative setups for intraday. Again, the class is coming up. It's a 3-hour class. In addition to it, we are going to have 5 hours of live trading on Monday, April 10th. The entire thing is recorded because clearly not everybody can take off Monday, April 10th. So we're recording the entire thing. The class is archived. It's got unlimited access. Okay. We will provide the entire slide deck just prior to the class on Saturday. Again, options 101, 201, 301 are all included. There's a futures, you know, basics class. Futures, we're not going to trade futures in the class, but we're going to discuss futures because that's the contract that you need to watch to get a better feel for intraday trading. We're also giving you a weekly options mini class to discuss weeklies because we're going to be using weeklies in order to constitute the types of trades that we're taking over here. But the what products to watch and why class, again, if you are listening and you're in the TheoTrade chat room right now, or if you're on the GoToWebinar and you're going to this class, please, to understand what's going on, watch this what products to watch and why class. We'll get you all set up with the indicator. That's easy. The entire class is $197 with everything in here. It's theotrade.com/day. By the way, here's some of the curriculum for the class. Obviously, we're going to be talking about intraday trades, probabilities in your favor. We're going to talk about analyzing markets, option setups in there, ranges in ETFs. So we're going to talk about expected move over there. I'm going to try to give you guys some market insights that people just are not aware of. Like, so many people do not understand like some of the simplistics and the market setups out there. We're going to give you a lot of tools and different strategies for analyzing different market conditions, how to minimize risk. That's just the first portion of the curriculum. This is a beast of a class. So we are going to talk about generation of returns on an intraday basis, even really, really small accounts. So one thing I'm going to discuss in the class is that if you do not qualify for the day trading margin rule, for those of you that know what that is $25,000. Okay. So the $25,000 day trading margin rule, we're actually going to talk about how you can use a variety of products to actually circumnavigate the day trading margin restriction. Many people are unaware that certain products in the marketplace do not adhere to the day trading margin rule. It's perfectly fine. It's all on the up and up, but you just got to learn which products adhere to the rule and which products don't. So even if you have, for instance, a $10,000 account, you can still trade on an intraday basis, just like everybody else. Okay. You just have to trade slightly altered products over there. We're going to talk about opening and obviously closing trades, market correlations. And, here's another huge portion of this class. You don't have to be glued to your screen all day. You literally don't have to chain yourself to the screens. We're going to take very small, very measured amounts of risk in this unique class over here. So if you have questions about it, and by the way, you could do that, or you could just sign up for Total Theo. Feel free. Check out, again, here's the actual site for it. I will throw the actual web address up for this. It's theotrade.com/day. Email our support. Okay. In fact, you don't even have to email support. You can click right here. We're there. Just put your name in and start chatting with us if you would like. But if you do want to email us, and by the way, you can email me at any time, support@theotrade.com. This is our phone number, 800-256-8876. Again, theotrade.com/day. People all the time ask me also what Total Theo is. And by the way, there's a great question in the chat room, so I got to get this one right up front. By the way, if you guys have never seen the chat room, this is the chat room. Okay, this is actually being broadcast. What we're talking about right now, it's being broadcast literally live into the chat room. So you're watching me watch myself, but the entire thing, it's a DVR, and you can even maximize the screen over here. It's pretty cool. You can rewind it instantaneously. We've got some pretty slick technology. We don't use GoToWebinar all that often, but when we do, it's something spectacular. Ooh, we're watching ourselves watch ourselves. Anyway, this is the chat room, so we can actually type in here to the chat room itself. There is no charge if you were a TheoTrade, okay, Total Theo member. Of course, there's no additional charge for the class. You're part of TheoTrade. It's just in the chat room. What TheoTrade really is, we charge $997 for the entire year. And it gives you access to, first of all, a full year of TheoTrade. At least once a month, we do a class. We email out trades. It also gives you access to every class that we've ever done, period. Like, how many classes have we done? Well, if you actually check out this theotrade.com/day, here's the classes that we've done. Okay. And you can just get an idea. 101, 201, 301, high probability, survive and thrive in extreme volatility. There's technical analysis classes. There's futures-based classes, planner get slaughtered classes, pairs trading classes, a whale workshop over here. What products to watch and why class. If you went out, you can actually buy the classes individually on our site, but it would cost you a couple grand. It's just $1,000 for everything we do. Again, and we email out trades. Okay, and we give you all our technical indicators and all of our scans, and we do it all at one price. Because when we looked at building TheoTrade, we looked at all, the entire industry, and I've been in the industry for, almost 20 years. Everybody's trying to nickel and dime you for every single thing. It's getting ridiculous. It's just, listen, you want to be part of TheoTrade? Phenomenal. We'll provide you incredible education. It's not just myself. Again, it's Tony Rago who's into, futures. It's Slim Miller. Nobody's got more experience. The guy's got 43 years experience in the marketplace. okay? And he's our, market technician. We have Jeff Bierman, who used to be the chief market technician at TD Ameritrade. Doc Severson. Doc's been around forever. Not to say that Doc is, a little older out there, but Doc's been around forever. But that's what we do with Total Theo. The class, though, is totally worth it. For $197, you're not going to go wrong in the class. We are going to really, I think we're going to blow you away with what we're going to do in the consistent intraday strategies and setups class. I've been working on this class now it's been weeks and weeks I've been working on it. Just the bonuses, though, alone coming to the class. This is going to keep you busy. If you sign up for it right now, you start watching the bonuses. They're in the can. They're ready. You can start, play tape right now. Again, even if you have drastic experience in this business, and drastic means years of experience, right? Please watch this bonus number 6, what products to watch and why before coming in there. I think it's not only imperative, I think it's like a prerequisite pretty much for going to this particular class. So if you have questions, by all means, I am here to answer them. Again, feel free to come to TheoTrade.com/day. We're here to answer a few questions. Looking at a few of the questions over there. Okay. By the way, somebody was saying, Robert was saying, I keep 150,000 in stocks and trade options with 25K to learn about the industry to suggest a different ratio. Actually, Robert, in TheoTrade, we've actually got an archive specifically on capital allocation. I'm gonna have some fun over here for a second. If you go in here, you can actually type in capital allocation, right? So you can actually searchable archives. So come in under capital allocation, and there's a specific session I did. It's an archive and one of the coaching sessions. So here it is. It's loading up, and this is precisely what it talks about. In fact, if you look at the screen right now, okay, it was showing you. Apologize for that, but it was actually showing you. It's the breakdown, and that's exactly what we do in this. You're not far off, but this is 50%, 20%. 25% here. It's actually showing you the breakdown of capital allocation. I thought, Robert, you might appreciate that. You know what? We have a negotiated rate. We have a negotiated rate on commissions for TD Ameritrade here in the United States. We do not formally have a negotiated rate for Canadians. I'm sorry. All right. I'm sorry. So I'm scrolling back up some of the questions. Doc is in here answering some questions too. So again, be careful of the 3 times ETFs. I think we got most of them. Again, I hope to see everybody at the class. Like, I feel strongly about a lot of classes, but during the trading day, if you really want to see kind of what I do during the trading day, check this out. It's TheoTrade.com/day. Thanks everybody for joining me here today. I'm going to be back on in our chat room first thing tomorrow. It's Friday morning. And of course, I'll be in there Saturday morning. Saturday morning, bright and early. It's 7 a.m. Pacific time. I like it. Again, TheoTrade.com/day. Have a wonderful afternoon, everybody. Bye-bye.